Welcome to Killik & Co.'s podcast for April the 29th. Quick glance back at last week revealed that economic conditions or sentiment surveys were certainly worsening, whilst equity markets were going up. We'll talk about why that is why that is actually happening at the moment. But certainly last week what we saw out of Europe were numbers, particularly on some of the PMI surveys, that were indicative of continued slowing conditions. Unemployment rates in Spain worse than expectation, retail sales expectations down as well. So really at almost every twist and turn it was looking poorer for European data. In the US we saw first quarter GDP. It was a respectable 2.5% for Q1, although Q2 and Q3 could be a little bit softer, but that 2.5% number again coming in slightly shy of expectations of 3 to 3.1% over that time. So in light of all of that, the UK probably had one of its better relative weeks. Our first quarter GDP came in at 0.3% growth, a number which beat expectations and has meant that sterling was probably one of the key features from last week, strengthening from that sort of low level of 149 about 6 weeks ago up to through 155 at the moment. So interesting for sterling. We'll take a look at the charts shortly. Taking a look towards this week, two key features. It's the start of the month, so this is the time when central banks discuss interest rates. We will certainly hear from the US and the FOMC meeting, which takes place on Tuesday. Expectations here that interest rates will remain pretty much where they are, between the 0.25% and commitment of the $85 billion per month QE program. And in the European region, we'll have probably the more interesting of the meetings this week. Over 43 of the 69 economists polled are expecting that they will make the move to reduce interest rates in the Europe area from the current 0.75% down to 0.5%. It's not a clear-cut decision, but certainly a potential market mover for Thursday of this week. So turning to some of the corporate results, we are in the main thrust of the US reporting season, and we're also getting a selection of good US names, UK names as well reporting. This first slide reveals the sort of key parts to this week. Those highlighted in black are companies that we will be watching with a fair degree of interest, as we have notes from our research departments on each of those companies. Really, the market is being sort of portrayed at the moment with commodities continuing to suffer weakness, share price weakness, and certainly some of the service sectors around the oil and gas sectors have also been showing some weakness recently. So Weir Group will be of interest on Wednesday, and obviously we've got BG, Royal Dutch Shell, coming out later this week. Rolls-Royce in Thursday, and we will be having a meeting with their investor relations team at Killik & Co. at some point during the course of this week. So turning to charts, the first chart I want to start with is really 10-year yields. So these yields that are from the sovereigns, and the one we're highlighting here, this chart, is Germany. And it's interesting to note that through the auctions that have taken place, where Germany is refinancing a lot of its debt, yields that investors are prepared to accept now are back down to those sort of lows that we saw during the sort of pre-European sort of crisis, the OMT program of last year. So what's that telling us about markets? Well, I suspect what it is telling us is that the markets are prepared to accept a very low level of return for 10-year money, because they do expect that the headwinds of economic growth will remain very tough for the next few years to come, and that QE programs and central banks will have to remain as accommodative as possible for possibly a lot longer than we currently envisage. This is the sort of message that I suspect is coming out from the sovereign bond markets at the moment. It's not just Germany. If we were also to look at yields on the peripherals, countries that are really suffering, particularly Spain, even here 10-year money is coming down quite a long way. This is the peak, 7.5% on Spanish 10-year. Look at it now, it's down to 4.2%. And in Italy, where we've now got some resolution to the election problems, we're down to a sub 4% level. So there really is no shortage of money that is prepared to lock in on lower and lower rates of return over 10-year periods into sovereign sovereign debt at the moment, and that I think is having ramifications for the stock market. Before we turn to the stock market, let's have a quick look at the currencies. This is the sterling picture, which I mentioned. Just really that sort of better than expected GDP number is continuing the trend of sterling strength that we are seeing at the moment, so that's that. In terms of results from last week, just want to mention Apple. Of course, it is the biggest company in the world, or certainly was at the time when it peaked out at $700. We're having a bottoming out period here of around $400. Results last week certainly were slightly guiding lower than expectations, but here we have a fact that, or a general feeling that we may have found the bottom on the stock price after what has been a pretty horrific quarter for them. So in terms of the FTSE, well, despite these headwinds and despite the sort of gloomier picture that's building at the macro end of the market, what we are seeing is that stock markets continue to remain trading quite firmly at this stage. And I do think that the two are connected. I think it's the lower yields that we are seeing now across the sovereign debt markets, the preparation for acceptance of lower returns over 10 years, which is now making cash flow yields on equities look even more attractive. So certainly those blue chip staple companies producing consistent cash flow are trading on 5, 6, 7% cash flow yields. I suspect over the course of the next few weeks and months we're going to see those yields start to pull in, and that means that people will be prepared to pay higher price earnings ratios for equities. So the story feels a confused one, but I think it is all predicated on what will remain very accommodative policy. Final chart for me here, as I say, is just a recap of the German 10-year position, picture that's emerging right across the board, and as I say, I suspect will be the main driver of financial markets during the course of the summer.